Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
Looking back at the week that just ended, the scene was, well, broadly positive. We saw markets generally rallying across most regions. There was a clear influence from, say, easing trade tensions, some signs of inflation moderating in key areas, and central bank signals that were interpreted as leaning pretty dovish. But if you peel back the layers, you see it was actually a pretty nuanced picture, depending on where you looked.
Okay, let's unpack that regional nuance then. Starting with the past week, ending May 30th, you mentioned a broad rally, but also maybe some hidden volatility, particularly in the U.S. Where should we start?
The U.S. is probably a good place. Yeah, we saw a solid rebound there after some recent choppiness. The S&P 500 climbed 1.88%. The NASDAQ Tech Index was up 2.01%. And the Dow Jones rose 1.60%. Pretty decent gains.
And the initial driver behind that seemed pretty clear from the headlines, right? Trade optimism got things going.
Absolutely. Markets got a definite lift early in the week. It was reports that President Trump was delaying that potential 50% tariff on goods from the European Union. Any whiff of trade de-escalation, it's been a positive for sentiment.
Right. But that wasn't quite the whole story. I saw mentions of some legal back and forth later in the week that dampened things a bit.
Precisely. Yeah, there was some legal wrangling in the courts around the executive branch's broader tariff authority.
Okay.
That introduced a note of caution. So you had this sort of direct reflection of the news cycle playing out in market movements.
Okay. Beyond the trade drama, what else moved the needle in the U.S.? Any sign the Fed's job on inflation is working?
There was a pretty significant one, actually. The Core PCE figure, that's the Personal Consumption Expenditures Price Index, which the Fed watches very closely. It fell to 2.5% year over year in April.
Okay.
What's key here is that's the lowest level we've seen since 2021. It's a notable step towards the Fed's target, if it can be sustained, of course.
And alongside that, consumer spirits seemed to lift a bit.
They did. The Conference Board's measure of consumer confidence, it surged, up 12.3 points to 98. And that snapped a 5-month losing streak. So it suggests that maybe, just maybe, lower inflation prints and steady job reports are finally starting to filter through to how people feel about the economy.
So wrapping up the U.S. picture for the week, stocks rode a wave of trade de-escalation hopes. That's kind of the headline takeaway. But for you listening, the nuance is important. Watch that legal uncertainty around tariffs. And while core PCE fell, inflation risk is still, a background factor everyone's monitoring.
Good summary. Moving across the Atlantic then, to the Eurozone. We saw more modest gains there. The StoXX Europe 600 was up 0.65%. Germany's DAX gained 1.56%. France's CAC 40 rose just 0.23%. And the UK's FTSE 100 was up 0.62%.
And those gains seem pretty directly tied to the growing expectation of an ECB rate cut, which the sources highlighted quite a bit.
They absolutely were. The catalyst was softer inflation figures coming out of key Eurozone economies. CPI slowed to 1.9% year over year in both Spain and Italy, right on the ECB's target in those places. And inflation cooled quite sharply in France, down to just 0.6% year over year. These numbers really strongly reinforce bets on a June rate cut from the European Central Bank.
But looking beneath the surface, the picture isn't entirely robust, is it? Especially in the labor market.
That's where you see some fragility showing up. We saw German unemployment jump by 34,000.
Wow.
Which was actually triple what economists had been expecting. Triple. And overall job openings in Germany are down year over year. So while inflation is cooperating, there are definitely signs of stress in the engine room of the Eurozone economy.
And wasn't there a point about consumer inflation expectations remaining a bit stubborn, even though the official CPI is slowing?
Yeah, this is fascinating. Yes. Despite those falling headline numbers, the ECB's April consumer survey showed households are still expecting inflation to be 3.1% over the next year.
Still quite high.
It is, notably still above the central bank's 2% target. So this presents a bit of a puzzle for the ECB, doesn't it? Do you ease policy based on the current data, or do you worry that consumer expectations could keep price pressures sticky down the road?
Right. So for the Eurozone, the headline is rate cut incoming, driving those modest gains. But the nuance to keep in mind is that tension between cooling official data and those sticky consumer expectations, coupled with a slightly wobbly labor market picture. It suggests the path for the ECB isn't perfectly clear-cut yet.
Exactly. Shifting focus slightly north to the UK, the FTSE 100 had that modest climb, up 0.62%, like we said. But the source material painted a pretty mixed picture there, too.
Yeah, it seems the UK is benefiting from the general global mood and maybe easing inflation elsewhere, but domestically, sentiment seems to be under a bit of pressure.
That's right. There are some specific pain points showing up in the data. For example, UK vehicle output in April. It slumped, down 15.8% year over year. The sources noted that was actually the worst post-war April figure outside of the COVID disruption years. That's a significant drop.
Ouch. And the services sector. That's so crucial for the UK economy. Seems to be struggling with confidence.
Exactly. Confidence in the UK services sector hit a 2.5-year low. The feedback suggests pressures from things like higher payroll taxes impacting businesses and just ongoing concerns about pricing power.
Is there anything in the data that offers a counterpoint? Something holding up okay?
Yes, one area showing some resilience is housing finance. Mortgage lending and approvals actually held pretty steady. It's a contrasting point that suggests that perhaps households aren't yet entirely stretched, despite the pressures businesses are clearly feeling.
Okay. So the UK story this week seems to be one where, global optimism and stable financial flows provide a sort of floor, but domestically, specific sectors are hitting speed bumps due to tax and cost pressures. A bit of a sentiment battleground.
Well put. Moving over to Asia now, Japan's markets saw a really strong surge. The Nikkei 225 was up 2.17%, and the broader Topi index gained 2.41%.
That looks like Japan benefiting from two factors.
Yeah.
Improved global trade vibes, like elsewhere, but also something interesting happening with domestic inflation.
You hit it. The geopolitical tone certainly improved, especially regarding trade talks. That helped. But the domestic inflation pictures are getting really interesting. The core CPI data out of Tokyo for May, it accelerated to 3.6% year over year.
Wow, 3.6%.
Yeah. What makes this stand out is that it not only smashed expectations, but was the fastest pace seen in over 2 years.
Okay, that's quite a jump, especially for Japan. How is the Bank of Japan responding to that hotter data? Are they getting nervous?
Well, BOJ Governor Ueda has maintained a, let's say, cautious tone so far. He acknowledged the trade-driven risks, reiterated the central bank's commitment to flexibility. Despite those hotter price figures, they're not signaling any rush towards aggressive tightening just yet. They're clearly watching to see how sustained this might be.
And on the trade front, there was specific optimism mentioned regarding the U.S., wasn't there?
Yes, there was positive sentiment following a reported call between President Trump and Japanese Prime Minister Ishiba. This was ahead of the mid-June G7 meetings. And it fueled speculation about a potential bilateral U.S.-Japan trade deal, which, would be a significant positive for Japan if it happens.
Gotcha. So the story for Japan this week is clearly benefiting from that global trade thaw, but this noticeable uptick in inflation definitely adds a new dynamic. It raises the question, can the BOJ really stick to its very, very gradual exit from ultra-loose policy if domestic prices keep firming up like this?
That's the key question now.
Exactly.
Finally, let's look at China, which was the clear outlier this week, lagging behind the global trend. The Shanghai Composite dipped slightly by 0.03%. The CSI 300 fell 1.08%, and the Hang Seng in Hong Kong was down 1.32%.
So while pretty much everyone else was rallying on optimism, China's markets were heading the other way. Why the disconnect there?
It seems to come down to a lack of conviction, really. The market reaction was pretty muted. We had light economic data releases, and the messaging around potential stimulus. Investors perceived it as vague. They were clearly looking for more concrete signs of support, and they didn't quite get them.
There were reports of potential stimulus, though, right? Targeting specific sectors.
There were. Reports suggested Beijing is planning a RMB 500 billion push that's roughly USD 70 billion, specifically for infrastructure funding, targeting areas like AI and the digital economy. It's a significant figure on paper, but the vagueness around the execution plan left markets wanting more details.
And the focus on manufacturing seems set to continue, which could have ongoing implications for global trade.
Yeah, early planning discussions for the next 5-year plan, the one covering 2026-2030, suggest continued strong state support for industrial activity. Now, while this supports domestic policy goals, it could indeed exacerbate global trade frictions down the line if it leads to, say, increased export capacity flooding global markets.
So weak data, vague stimulus hints, that sounds like a recipe for the kind of fragile sentiment we saw.
It absolutely was. The relatively quiet data calendar this past week meant there wasn't much fresh, positive news to counteract that feeling. It left sentiment quite brittle as investors just waited for clearer policy signals.
Right. So summing up China, the market reaction was one of disappointment, really. Hopes for more decisive stimulus and clearer data signals were kind of dashed. Hopes for support are definitely there, but regaining investor confidence will likely require Beijing to demonstrate credible execution of those plans. Show us the money, basically.
Pretty much.
Okay, that gives us a clear picture of the week that was. Now let's turn our attention to what's on the horizon, because the week of June 2nd through June 6th looks absolutely packed with potential market movers globally.
It really does. The data calendar ramps up considerably, and we have some critical central bank events. If you're watching markets next week, definitely demands your attention.
Okay, let's talk through the highlights, starting again with the U.S. What are the absolute must-watch data points coming up?
For the U.S., all eyes, and I mean all eyes, will be on the labor market data, culminating on Friday, June 6th. That's when we get the non-farm payrolls report for May. This is arguably the single most important piece of economic data each month for the U.S. economy and the Fed. The consensus right now is looking for about 130,000 jobs added, with the unemployment rate expected to tick up just slightly to 4.2%. We'll also be digging into the details like average hourly earnings, both month-over-month and year-over-year growth, and the participation rate.
And why does it matter so much again? Just remind us.
Well, because the strength, or indeed the weakness, of the labor market directly impacts wage inflation. And that heavily influences when the Fed might feel comfortable actually cutting interest rates.
So weak NFP fuels rate cut bets. Strong NFP potentially pushes yield higher and delays cuts.
That's the basic trade, yes. And ahead of that big Friday number on Wednesday, June 4th, we also get the ISM Services PMI. Remember, the service sector is the engine of the U.S. economy, and we get its related employment and prices components too. Those will give us a crucial read on hiring and cost pressures outside of manufacturing, providing kind of preview for Friday.
Okay.
Oh, and we also get the usual weekly jobless claims on Thursday.
Got it. Over in Europe, there's one date circled in bright red on everyone's calendar, I assume.
Absolutely. Thursday, June 5th is the European Central Bank's rate decision, followed by President Lagarde's press conference. The market is now overwhelmingly expecting a 25 basis point rate cut at this meeting. It's almost a done deal in terms of pricing.
So the cut itself isn't the news.
Exactly. What's fascinating here is that the cut itself is largely priced in. The market reaction won't be about if they cut, but entirely about the forward guidance. What does Lagarde say about the path forward? Does she signal more cuts are coming soon, or is this potentially a one-and-done move for now? That's what traders will be dissecting word by word.
And earlier in the week, we get more color on that inflation picture you mentioned earlier, the sticky expectations versus falling CPI.
Yes, on Tuesday, June 3rd, we get the Euro area flash inflation data for May. We saw those Spanish, Italian, and French numbers cooling last week, but the flash data for the entire Eurozone will give us the full aggregate picture. And this is important because, as we discussed, that divergence between falling headline CPI and still sticky consumer expectations is a key challenge for the ECB. Seeing how the broader measure looks will be vital.
Right.
Also on Wednesday, June 4th, we get the final HCOB composite and services PMIs, giving us a comprehensive view of business activity. And wrapping the week on Friday, we get the final Q1 Euro area GDP growth data.
Okay. How about the UK? What should we be watching closely there?
For the UK, the key release is probably the S&P Global Services PMI on Wednesday, June 4th. Given the weakness in services sector sentiment we just talked about from last week, this will be an important check on whether things are deteriorating further or stabilizing. We also get the Halifax House Price Index on Friday, June 6th, which will add to the picture of that steady, albeit perhaps fragile, housing market.
Japan had a strong week. What's coming up that could influence their trajectory, especially with that inflation surprise?
On Wednesday, June 4th, we get the final Meijibun Bank Services and Composite PMIs. Like in the U.S. and Europe, the services sector data is really crucial for understanding domestic demand strength, especially amidst those external trade risks and now rising inflation. On Friday, June 6th, we also get April household spending data, which, as a side note, actually came in stronger than expected earlier today, a positive sign for consumers.
Oh, interesting.
Yeah. And we also get the leading and coincident economic indices, which have been broadly stable. The focus remains on whether that recent uptick in Tokyo inflation shows up in broader measures or starts to impact consumer behavior more noticeably.
And China, after lagging last week. Anything key there?
China have one key release to watch early in the week. The Cakes and Manufacturing PMI for May. That's out on Tuesday, June 3rd. This is a vital independent survey giving us an early read on the health of China's factory sector, separate from the official PMI. After that quiet data week and the vague stimulus messaging, a disappointing print here could certainly amplify fears of a global demand slowdown, especially given the ongoing trade tensions.
Okay. So layering all of this together, all these data points, the ECB meeting, what are the top risks you see for markets heading into this really data-heavy week? Let's break it down.
Yeah, based on everything we've covered and what's on the calendar, I'd probably highlight these top 5 risks for the week ahead. First, U.S. labor market wobbles. The potential for Friday's non-farm payrolls report to surprise significantly either way feels quite high. A much weaker number could fuel aggressive Fed cut expectations, maybe hit growth-sensitive assets, but a much stronger number could send bond yields spiking and really raise questions about how quickly the Fed can actually ease policy. Big implications either way.
Okay, risk number 1, what's next?
Second, an ECB dovish surprise. Or maybe not dovish enough. While that 25 basis point cut is expected, the market is hyper-focused on the forward guidance. Any suggestion from Lagarde that this might be the only cut for a while, or that the path forward is very slow, could be interpreted as hawkish relative to current expectations. That could cause some market disappointment. Conversely, strong hints of more cuts could boost sentiment further. It's all about the messaging.
Right, the guidance. Risk 3.
Third, sticky Eurozone inflation proves persistent. That flash inflation data on Tuesday needs very close watching. If the headline number doesn't cool as much as hoped, or if core measures remain stubbornly elevated, it just underscores the challenge for the ECB, even as they likely cut rates. It keeps the focus on that tricky consumer expectation figure we talked about.
Makes sense.
Fourth, China growth stalls further. That kicks in manufacturing PMI on Tuesday is the key risk event here for China watchers and potentially globally. A weak reading would confirm fears about soft domestic and perhaps global demand, potentially weighing on risk assets globally, especially anything tied to commodities or industrial production.
And the 5th risk.
And finally, number 5, the BOJ policy pivot risk in Japan. That surprising acceleration in Tokyo CPI really puts the Bank of Japan under the microscope. While Governor Ueda is staying cautious for now, continued hot inflation data coupled with potential yen weakness if other central banks like the ECB are cutting rates. Well, it could force the BOJ to signal a faster path away from negative rates or asset purchases sooner than the market currently expects. Friday's household spending and PMI data will add more pieces to that particular puzzle.
Okay, so recapping the week that just ended, markets generally saw a rally, largely fueled by a seemingly better tone on trade and some cooling inflation data in key regions like the U.S. and parts of Europe.
Yeah, looking ahead, June kicks off with an absolute deluge of global economic data and those crucial central bank decisions, particularly from the ECB on Thursday.
Which means, yeah, buckle up. Expect market positioning to adjust, possibly quite quickly, based on this new information. Traders will be digesting fresh insights on inflation expectations, central bank policy paths, and any concrete signs of growth picking up or, conversely, slowing down.
The sheer volume and the significance of next week's data are hard to overstate. It's a big one.
So here's a thought for you to take away and maybe chew on as you watch the headlines unfold next week. Given this perfect storm, really, of major data releases and critical central bank meetings all happening at once, can the optimism that lifted markets this past week actually endure? Or is the market perhaps poised for a potentially sharp repricing based on the new realities these figures might reveal? Something to consider.
Indeed, a key question for the week.
Thank you for joining us for this deep dive into the markets. We'll be analyzing it all right alongside you.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.